Make no mistake about it, bear markets are life-changing opportunities in the stock market. They've changed many lives, and they're likely about to change yours if you play it right. But the death cross that we were talking about on the S&P 500 just hit. The battle between Donald Trump and Jerome Powell continues to heat up. If you guys have been following this channel for at least 5 months, you know that this was my main theme for 2025. Was the battle between Donald Trump and Jerome Powell, and now it has been taken to the next level with Trump signaling that he's trying to fire Jerome Powell and he wants him to lower interest rates. And the VIX seems utterly stuck at the 30 level. So in this video, I'm going to be giving you a full technical analysis of the markets, how I see it, where I see the markets going, what we should look out for, and then more importantly, what stocks I think are undervalued at the moment, and what potential trade setups do I see coming up in the near term. Let's get right into it. So as I said, Donald Trump has been signaling that he's attempting to fire Jerome Powell. Now, it's important to remember that he did this back in his first term, even though he's the one who approved Jerome Powell's appointment. But he said, if I want him out, he'll be out of there real fast, believe me. And then he said, he's too late. He's always too late, a little slow. I'm not happy with him. This is because Trump wants to get Jerome Powell to lower interest rates. Obviously, every single president wants the Fed to generate an easy path to basically money printing because that fuels the economy and that fuels the stock market. But especially now at the moment where the S&P 500 and the stock market in general is suffering a big hit, Trump is trying to shift blame towards Jerome Powell when, in all honesty, one, Jerome Powell doesn't really have a need to lower interest rates currently, and two, this sort of volatility is not Jerome Powell's fault. Let's be honest. I really don't want to be put in a position to defend the Fed, but I call it how I see it. As a matter of fact, CPI has been coming down, and the last print we got was 2.4%. Now, why can't Jerome Powell lower interest rates? It's because the Fed only has two mandates. One is price stability. Two is maximum employment. Unemployment numbers continue to impress. We are not seeing any cracks in the unemployment numbers, even from the DOGE initiative where supposedly hundreds of thousands of federal workers were fired. Nobody's seeing that in the numbers. And two, the other initiative is price stability. So if the Trump tariffs are not concluded yet, and Jerome Powell and the rest of the Fed, they don't know what the potential inflationary effects of those tariffs will be because the tariff policy isn't done, then obviously they cannot just lower rates based on a willy-nilly, based on vibes, basically. And if we take a look at the Fed funds futures, there are no cracks in the system. Still 86% likelihood that the Fed does nothing on May 7th. Now, it's important to remember that the actual Q1 GDP numbers come out April 30th. And as of right now, the Fed is still projecting a negative 2.2% quarter for Q1 of 2025. I've talked about this before, but the Fed has never projected a negative number that has then come out positive. The opposite has been true. They have projected a positive number that has come out negative, but never in the history of the Atlanta Fed GDP Now projection have they projected a negative GDP that has surprisingly come out positive. Now, in terms of recession odds, if we just look at the bond market, it is very likely that we do get a recession. We need two back-to-back quarters of negative GDP. So if we get the first one on April 30th, then we'll need a second consecutive one for Q2. And we will likely be in a recession. There is some good news there, though. But if we look at the bond market, going back 45 years, every time the 10-year and 2-year invert, meaning the 2-year bond pays more than the 10-year, and then it uninverts, that is when we usually get a recession. It's not because the 10-year, 2-year uninverted. The 10-year, 2-year is basically a leading indicator of a recession. So you can see here that we uninverted in 2022. We inverted in 2022 and we uninverted at the end of last year. And we are now once again steepening, and that is when we typically get tripped into a recession. So the timing of this, if we do get a negative GDP, actually makes sense from the bond market's perspective. Now, the reason why that would be good news, obviously recessions aren't good news if people are losing their jobs and losing the ability to pay for things. So hopefully if we do get a recession, it's a very short and shallow one. But if you take a look at the last 6 recessions, the trend that we typically see, if we take a look at the blue dotted line in all of these graphs, the blue dotted line is the S&P 500. This puke green line is the GDP. The S&P 500 always bottoms out before GDP does. Meaning, if we get the first quarter of negative GDP, before we get a second quarter of negative GDP, the S&P 500 will likely have bottomed out. This has happened every single recession for the last 6 recessions going back to 1957. I think the only time we did see this prolonged was in the dot-com era, which is why it is not on this chart. But you could see the trend here. And aside from next week being GDP week, we also have major Mag 7 earnings. You can see here that next week is when the real fun starts, where we have Microsoft, Meta, Apple all reporting earnings in conjunction with fan favorites like SoFi and PayPal. It'll be very interesting to see whether these companies that typically offer guidance, whether they will offer guidance or not. Apple doesn't offer guidance, but a lot of these companies do. However, we've seen something very unique now where companies are actually offering 2 sets of guidance, one for the recession case and one for the non-recession case. That is not confidence boosting. Now, let's take a look at the S&P 500 and do some technical analysis. As I said in my previous video, my first level was the high of 2021. That was the level we dropped to. However, that doesn't mean that that is the bottom. There's actually a lot of confluence that suggests we might be seeing lower lows here coming up in the near term. So let's pull up the simple moving averages here. You could see that we recently hit a death cross. Now, a death cross is not always a death sentence. However, it often is. So we see this death cross here in 2022, and that is where we marked a prolonged bear market. However, we did see a death cross happen in non-bear markets. Here you see the one in 2020, which was a very fast bear market thanks to the money printing. You can see here the death cross in 2018. This was a correction, a double dip correction, where we had a correction in the first half of the year, a nice rally during the summer, and then a second larger correction. However, not a bear market for the S&P 500. A double dip correction in 2015 and 2016. We also had a death cross there. And then the correction of 2011, we also had a death cross, but you can consider this a stage where we were crawling out of the 2008 financial crisis still, and we hadn't yet hit the highs from 2007 until we got to around 2013. I'm going to get back to the pure technicals in a second, but this is why I think that there can be more downside here and why this is worrying. So if we take a look at something called the S&P 500 Shiller-Cape ratio, I promise I'm not going to make this boring for you. You can read about this ratio in detail, but in summary, what it says is this is a 10-year projection of the S&P 500 based on inflation-adjusted earnings. And if we take a look at where we're at right now, we're still around the 33 level, more than 1 standard deviation above the mean. So when we couple this death cross with the fact that we are more than 1 standard deviation above the mean, this has always resulted in a bear market. Here's the top in 2021 before the 2022 bear market. This right here, you can imagine, is the dot-com bubble. Now, oddly enough, when I was looking at this, we were not that overvalued in 2007 based on this metric. So this wasn't the cause for the 2007-2008 crash wasn't overvaluation. Obviously, we had a very disruptive and broken credit system where we were giving out mortgages, selling them as A+ mortgage-backed securities, etc. You guys know the whole story of the Big Short. So I did find it interesting that we were not that overvalued based on the CAPE ratio, the S&P 500 Shiller-Cape ratio back in 2007. Now, if we take a look at current valuations of the different markets, you can see the Nasdaq 100, Russell 2000, S&P 500, the equal weight S&P 500, and the S&P 500 mid-cap, which is severely undervalued here, trading at recession levels already. But we are very far from the 20-year median on the Nasdaq and on the S&P 500. Russell 2000 is currently trading in the bottom range of this 25th to 75th percentile. The S&P mid-cap 400, like I said, is trading towards the 5th percentile range, one of the worst valuations in history at the moment, or lowest, I should say. And then the equal weight S&P 500 is actually trading at the 20-year median. But we still, based on valuations, if we are going to revert to the mean, especially if companies, huge companies, continue to either give out mixed signals in terms of guidance or refuse to give guidance altogether, I could see us going through a valuation crunch where stocks come back to a closer to the 20-year median. So I do think that the S&P 500 is based on valuations. If we do get some earnings compression, I do think that it has a little bit left to drop before it reverts back to the mean and resets itself for then another rally. Now, before we get into the individual stocks and what trades I'm looking at, another thing that is concerning here is the length of time that the S&P 500 has stayed below the 200-day moving average. We are now coming up on almost 41 days that we are below the 200-day moving average. When we've seen little corrections like the one in 2018, we don't typically spend that long below the 200-day moving average. Typically, when we spend this length of time below the 200-day moving average, the market has come to grips with the fact that the S&P 500 is breaking down, right? They're not coming in and stepping in to rescue it immediately. Now, obviously, the thing that makes this precarious is if Trump tweets out, we got to deal with China, Trump tariffs are off, you're going to see some euphoria, of course, that is then going to shoot us. We're going to see a very violent rally. But as long as the Trump administration and Scott Bessent are focused on the 10-year, which they have said all along, right? Their goal is to bring yields down. That lowers the government interest payment because the government cannot continue to pay interest at 4 or 5%. They want to lower these yields. And unfortunately, the only way to do that is to try to slow the economy. And they're doing it in this chaotic manner where there's just a constant news cycle of off again, on again tariffs, right? It has worked initially, but then it seems to have stalled right now. So it'll be very interesting to see what are the tactics that are going to spring from the White House in order to try to lower these yields. If we do get a negative GDP, that should help. But Powell is not going to lower the Fed funds rate, so we'll likely see this continued confusion surrounding the tariffs. Now, I do find it interesting that the Federal Reserve last week said that they're ready to intervene if liquidity issues arise. So I do think that that is also a possibility where in order to bring these yields down, the Fed will likely start buying assets once again. And once they buy up the treasuries that are on the market, that will then lower the yield. So that is sort of a, during an emergency break glass situation. But until the 10-year drops or the White House says we don't care about yields anymore, we gave up on the fight, you cannot honestly be that confident that the market is going to see any sustained rally. One other thing is that the VIX is still above 30. I think people underestimate just how long the VIX can trade at elevated levels. People think that it just spikes and then that's it. But this guy, well, I want to give credit here, Chris Sidiel, apologies if I mispronounced that name, but he put together a history of the VIX when it was trading at elevated levels for a long time. You can screenshot this and read it for yourself. But you can see here in 2001, spiked to 57, stayed in the mid-30s for 2 months. In 2002, hit 56. It reached 53 times and hovered in the mid-40s for 4 months. In 2008, it was in the 60s for 2 months, so on and so forth. You could see that the VIX isn't really this instrument that just spikes and then comes back down, and it's so easy to short volatility, especially during extremely uncertain times like this. So I'm going to be paying a very close attention to the VIX, seeing does it remain at this 30 level and above, or do we finally get a VIX crush to the 20s? If we finally get a VIX crush to the 20s, and more importantly, I want you guys to Google VIX term structure, and you come up with this chart here. This chart is not supposed to be sloping downwards. This is called backwardation, right? The VIX typically is sloped this way, meaning that volatility, the further ahead in time, the less unknown the conditions are, the higher the VIX is, right? Because remember, the VIX are futures. So every month is typically higher than the previous month, right? But when you see this, it means volatility is still extremely elevated. We typically will not see a bottom until this is reversed and it looks like that. So I'm going to be watching the VIX and the VIX term structure to see whether the volatility persists or not. I'm also obviously going to be watching the 10-year yield. I want to see if it's going to come down or not. And I'm going to be looking for any headlines that the Fed is actually going to start quantitative easing and buying assets off of the balance sheet. Those are fundamental stories that will likely change the price action in the markets. Now, aside from the White House changing course or the Fed stepping in, where do I see the S&P 500 going? If we take a look here at the 3-month chart, which is basically broken up by quarters, you can see that we have a top reversal pattern, right? We never see a top reversal pattern that just ends here. That would be the fastest in history, actually. If I pull up the 21 EMA, I'm just trying to think out of the box here. If I pull up the 21 EMA, you could see that we typically revert to the 21 EMA during bear markets, right? Here you could see 2022, here's 2020. We haven't even touched the 21 EMA yet. So on the S&P 500, on SPX, that's around 4,500. And if we take a look at the weekly chart, you can see that the 200-week EMA is somewhere between 4,500 and 4,600 on the S&P 500. So that is honestly the level that I'm aiming for. Now, in terms of how we get there, I've told you guys this in my video last week, but I could see a point at which price action potentially rallies towards that April 2nd high, right? This is where Liberation Day, quote unquote, this right here was Liberation Day where the tariffs were announced and all this mayhem started after that. So I could see us potentially retesting that level. And at that point, I would likely look for a short from that level. Obviously, my ears will be tuned very acutely to the news cycle and what's going on with bonds, what's going on with the VIX, what's going on with the White House. But that is the level that I'm potentially eyeing for a short. So as I said, it's not set in stone. Don't just come here and short. I'm looking at that, but obviously my opinions can change based on the news cycle. All the trades that I take will be sent out in the Traveling Trader Academy, which is the Discord. So if you want real-time alerts, sign up below. In terms of stocks to buy, let's take a look at the Mag 7 real quick. If we look at the Mag 7, we are approaching levels where, in my view, it is way more risky for one to not buy here than it is to buy here and potentially have the price drop a little bit thereafter. So if you look at this summary here, this is the Mag 7 plus Netflix, right? Which absolutely killed earnings, by the way. If you look at what is the most undervalued based on forward PE, you obviously have Alphabet, Meta, and Nvidia, right? These are the most undervalued based on forward PE. Now, Netflix, like I said, absolutely killed earnings, currently trading over $1,000 again at around 1,006. Does Netflix have any real tariff exposure? And the answer is no. So if you are going to invest in the Mag 7, in my opinion, you should focus on ones that have very little tariff exposure, that are the most undervalued, that have double-digit trailing 5-year growth, and that have double-digit estimated long-term growth. So you can see here that Alphabet, its long-term growth is projected at 7%. That is pretty modest, but if you look at its PE, its forward PE, this is the cheapest that Alphabet has traded in a very long time. And in my opinion, I do think that they do have some sectors that are not yet priced in for long-term growth. Their Waymo division is growing at a rapid clip. Obviously, a lot of the AI initiatives are not even priced in here. So for me, Alphabet is definitely on the list. Meta is for sure on the list at these prices now. Both of these companies do not have tariff exposure, just like Netflix, which is back to levels like if you looked at Netflix, you wouldn't even think that there was anything structurally going on in the market. It's trading in the same range that it was trading before the inauguration even. Now, Nvidia and Amazon both have high tariff exposure. Amazon, because its main business comes from the retail section, which most of the products come from China, and then obviously NVIDIA with the chips. However, NVIDIA's trailing 5-year growth is a whopping 92%. Amazon's is 39%. And the estimated long-term growth for NVIDIA is still 25%. We're not even scratching the surface as it relates to chip demand. So in my opinion, NVIDIA is definitely in accumulation phase out of the Mag 7. And then Alphabet and Meta are both safe buys, as the tariff exposure is just not really there. And they're just dealing with the overall market volatility and not so much anything that is fundamentally affecting them from what is going on right now. Another stock I talked about for long-term pickup was XLP, which is the S&P 500 Consumer Staples ETF. And consumer staples tend to fare better during recessions than obviously consumer discretionary, which are classified as optional items or luxury items. Consumer staples never go out of style, and picking some up here was definitely a surefire bet. If we get back to that level, in my opinion, if you are looking for less recession exposure, I think XLP should be on your list. I also recently picked up a little bit of XLV, which is the healthcare sector of the S&P 500. Although I am eyeing this 123 level of XLV to really increase my position in my long-term portfolio. Another stock that I'm bullish on is ASML. You could see this trend line here. Let me make it brighter for you, but this trend line has existed since 2008. And if we take a look at ASML's valuation here, and I pull this up, you could see that ASML right now, the 4 PE ratio of 24 is lower than its 3-year average and 5-year average. ASML is not a chip company. They do lithography, which is a process that is vital in terms of chip manufacturing, and they are the only ones that do it at scale. So they've had a monopoly for over 30 years at this point. So in my opinion, it has the ability and shown the ability to sustain an economic advantage in its market. It is a monopoly in its market as well. It has long-term growth. It has a history of share buybacks. Its debt to equity ratio is super low. It is a profitable company that has been profitable for a very long time and is currently trading at valuations that it is well below the 5-year mean. Hopefully those are some valuable ideas and insight for you. And if you're scared to invest, just think about, we went through the Great Depression, World War I, World War II, the Vietnam War. We went through the 1980s recession, stagflation era. We went through the dot-com bubble, the 2008 financial crisis, and the market continues to bounce back. Also, we are nearing the point where it is almost guaranteed a year from now, we will be greener than where we are now. Remember, the market dropped already almost 20%. The NASDAQ dropped over that. But what we are seeing in the VIX here is peak fear. And what typically happens, if you look here, historical closes above 50 from 1990 all the way until 2025. You could see the track record here, the 1-year through 5-year track record when the VIX spikes 50 and above. Here's what happens when the VIX goes from over 50 to below 30. Yes, you could see some bumps in the road a few months later, but 1 year later, 100% of the time we were green. And here's what happens after we get those huge percentage gains, especially during bear markets. So I'm going to remove the camera and take my fat head out of the picture, but we had that 9.5% gain on April 9th on the S&P 500. You could see when it happens during a bear market, you definitely a few months out could see some bumps in the road. But 1 year out, you are almost always guaranteed to be green. The worst case scenario was the dot-com bubble. It was only 14% down a year later. 2008, 9% down a year later. Obviously, those eventually recovered. This is why at the outset of the video, I said that this is a life-changing opportunity. When you continue to buy as the market continues to escalate in terms of peak fear and these valuations continue to break down back towards their mean, once the Trump administration is done with their crusade on yields, once they introduce a new round of tax cuts, which obviously is going to give everybody extra liquidity, if the Fed steps in and starts buying treasuries and printing money, when the federal funds rate is finally lowered, because obviously the rates are not going to stay here forever. Think of all of the easy money that is going to pour again in the market. And if you are not someone that paid attention to these valuations that some of them are getting to absurd levels, and if you're not paying attention to the data that says, hey, Right now, what we're dealing with is scary. It's peak fear. But think 12 months out. Anyway, I hope these videos help you. That is what they're designed to do. If you want me to make more frequent videos, I've gotten that request a lot, that you guys would like more frequent videos. I will try to make more frequent videos if it helps you. If you want all of my trades in real time, all of my investments in real time, we also do a call once a month with the investing group. Sign up, link is in the description below. There is the group that includes everything: trading, day trading, swing trading, the market open calls, etc. And then there's also a smaller subgroup of just investing only. If you're not interested in trading, obviously comes at a much cheaper price point as well. Pick whichever one is right for you. Link is in the description below. Join us, subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.